Presented by Policybazaar.
CNBC TV 80, the Policybazaar Insurance Show.
Well, in the last 2 years, you pick up any major research report, all of them getting centered around expectations of a very strong growth in India's insurance sector. Now, two important things to note here. A, this sector has already been growing at about 15 to 18% each year in the recent past. And B, it's not a small sector by any means. Just in FY24, the insurance companies in India collected a total premium of 7 lakh crore rupees. Now, as far as reforms are concerned, there's another common thing amongst these research reports coming out. They all list regulatory reforms in the last couple of years as one of the top 3 reasons for the change in the industry. We have with us the man behind a lot of these reforms which have come out in the recent past, Mr. Debasish Panda, the chairperson at the insurance regulatory body, IRDAI. Mr. Panda, first of all, thank you so much. Appreciate you sparing the time and joining us today.
So thank you very much, Yash, for having me here today this morning. And my apologies, I couldn't make it in person to Mumbai, but I would like to also welcome the viewers today who are watching this show. First of all, thank you for understanding and appreciating the changes that have been brought around in the insurance sector. If you look at the Indian context, yes, the market is growing. Insurance, there is a felt need for insurance, even growing also across sectors. And therefore, and it's also true that insurance was a low priority need. But in recent times, we have seen that there's a rise in the per capita income. The middle class is widening. The purchasing power has got enhanced. The millennial population who understand risk and insurance better are keen to buy insurance. All of this also has led to the share in the discretionary spend increasing. And that is benefiting also in terms of spending in financial products, which includes insurance. We have also seen that the sector has got, particularly the health sector or the health segment, further impetus by the COVID-19. Overall, the financial awareness is on the rise. Yes, much more to do, but yes, it is on the rise. Now, the second thing that is happening, what is or necessary to be done, is that the industry now needs to harness the economic and the demographic shifts. And also simultaneously, you have to instill trust in insurance in the minds of the policyholders or the prospects. And that could be only done by creating a delightful experience for the policyholder. I mean, it should start right from the solicitation till the settlement of claims, the entire life cycle of the product. So what have we done? What was necessary to be done was to facilitate the insurance sector to create such an experience. The regulatory framework has been made more enabling and more supportive. And the foundation of insurance for all rests on making insurance simple, making it available, making it accessible, and also, most importantly, making it affordable. So how we have done this, I would actually put it in 4 blocks. So what we did was we divided our goals into 4 building blocks. 1, to refine the present. 2, leverage technology and data. 3rd, how do we reach out to the last mile, the last household, and the last person? And how do we make ourselves future ready in order to achieve the vision of insurance for all by 2047. So these are all at a very advanced stages of implementation, and we are taking the industry on board so that there is no communication gap, and we are fully aware of what is going to come in the future. So this, I think, will further stabilize the financial sector, particularly the insurance sector, in terms of its, the framework that is being created. This will be the key to achieving insurance for all. So therefore, this is the framework on which we have worked tirelessly for the last 2 years.
Well, certainly that's a very positive note that we aspire to achieve. But if you look at the sector today, there are about 27 life insurance companies, 25 general insurance companies, 7 health insurance companies. In your understanding and in the way you read it, to cater to a population of about 1.4 billion people and counting, do you think the sector needs more consolidation? Or do you think there are more companies which need to enter the space? My question to you is that do we need lesser and larger life insurance companies, or do we need more fragmented and niche life insurance and general insurance companies in the sector today?
See, I think it'll be a combination of all. The market will churn. There'll be eventually consolidation will also happen. The smaller ones who may not achieve the scale despite having been there for a sufficiently long period of time in the market, there could be consolidation. Then at the same time, you will see new players entering into the field because of the strong economic growth of the country, the revamped regulatory architecture. That thirdly, the purchasing power being enhanced, the widening middle class. So all of these are drivers of growth, and it's bound to happen. And we see that there is a lot of interest being evinced by the global investors to come and invest into in the Indian insurance industry.
Okay, I'll come to the global interest in just a bit, but before I do that, I just wanted to ask you for your views on this particular question. Out of 27 life insurance companies today, only 5 are listed on the stock exchanges, which means they've gone public. Out of 25 general insurance companies, we just have 2 companies which are listed. Also, as far as the standalone health insurance sector is concerned, we have 2 companies there which are listed on the stock exchanges. What would be your advice to the insurance sector, to individual companies in terms of public listing? How could they help policyholders and their shareholders once they list? And, what would be your communication to all these companies in this context?
No, I fully agree that, you see, listing would be a natural progression. Once you achieve the scale, size, or the age, you got to list the company, and it should happen. Listing also brings in a lot of benefits in terms of better disclosures, more value for the policyholders, more value for the investors. It would enhance the customer confidence. It would, even open up access to raising more capital, and it would support growth, innovation. So all of that follows with the listing of a company. So the number of companies which are listed, in life we have 4, in general we have 3, in the standalone health insurance space we have 2, then we have 1 reinsurer. So the total number is 10 at the moment, and we are in engagement with the industry that once the criteria of either the age or the scale criteria, and we are nudging them to go for listing. And I expect that you will see in the coming months and years more companies, going for listing, or at least preparing that roadmap.
And what is that exact criteria that you're looking at? What is the ideal age of an insurance company? What is the ideal size of the book that these insurance companies need to have, once they start considering listing publicly on stock exchanges?
No, as I said, age, you also look at the scale. Maybe you look at the AUM, what is the total size of the AUM for life insurance. So it's not one or the other, but we will look at all of this and then shortlist that these are the companies which are ready to go. But you also see people, I mean, there are companies who haven't attained that age also have gone and listed. So the whole idea is to keep nudging, but those who have attained size, scale, and also the age should go for listing. So that is what we would be doing in the coming future. And we are already started engaging, and we'll have more intense discussions also on that.
Hopeful of that, Chairperson, sir. One question as far as foreign direct investment in insurance sector is concerned. Now, when the FDI was raised from 74% from the earlier 49%, that did not garner a lot of foreign interest. What makes you confident at this point of time that FDI, when it goes to 100% all the way from 74%, there would be a lot of foreign players that could come into the insurance space in India, also a lot of foreign capital that would follow. And when you look at the sector today, what would be your communication to the government to consider taking FDI to its optimum limit of 100%?
You see, FDI, obviously, we will look at FDI because you need a lot of this is a capital intensive sector, as you understand clearly. And insurance is not different from the banking or any other sector. Rather, the insurance sector is about 400 to 500 times more leveraged. So now, given that the insurance sector is poised for a substantial growth, and you yourself said in your opening remarks that they are growing at from between 15 and 18% growth annually. And there are certain reports also, there's, I think, the Swiss Re report, which clearly says or forecasts that the insurance premiums in India will rise by more than 7% in real terms over the next 5 years. And that would outperform the global average of 2.4%. And for the emerging markets, it's around, I think, 5%. And for advanced market, 1.7%. So if that is the kind of scale and size in which the Indian market would grow, obviously adequate growth capital will be vital to harness this potential. So therefore, we have to perhaps look at FDI also, and if 100% FDI is allowed along with the growth capital or the required capital, it will also bring in global expertise. It will bring in capacity, technology. So all of that will definitely bound to happen. So perhaps this has become the opportune time for having 100% FDI. So what will help potentially to the 100% is that it will play out in the sense now the players will come with 100% FDI. They can plan their business independently. They can decide on their growth plan. They can decide what kind of business they want to write. They can infuse the capital very promptly and easily because they don't need to depend upon their domestic partner. So all of this will also be a concomitant benefit which will accrue. And therefore, we need to perhaps think about. But however, I'm sure that the government will take a decision on this at the appropriate time.
CNBC TV 80, the Policybazaar Insurance Show.
Okay, three important things awaited as far as the Indian insurance sector is concerned. The first one is composite insurance license. The next two are IFRS and risk-based solvency. As far as composite insurance license is concerned, that lies with the government with respect to a awaited parliamentary approval before it can get applied. The other two, that is IFRS as well as risk-based solvency or risk-based capital, are in the regulator's hand. Two questions as far as composite insurance license is concerned. What is your expectation in terms of, do you expect it to get approved in the winter session of the parliament from the parliament's point of view, and then be applicable from 1st April 2025? And with respect to IFRS and risk-based capital, what is the progress on those, and when do we see both of them getting applicable on the sector?
So the first question you have yourself answered. So I will not go into that as to when it will happen. So as far as the amendments are concerned,
your expectations, sir?
I would expect the moment it comes, it is welcome. The earlier, the better. So that is something will be known to all of us as and when it happens. The second issue regarding the risk-based capital regime and the IFRS, and also I said a risk-based supervision framework, which we are trying to establish for a more robust and resilient risk and prudent risk management framework. So we are in the middle of the journey, in the sense the first qualitative impact study has already been completed as far as the risk-based capital framework is concerned. The results are with us. So we are, as I said, in the middle of this journey. We will be looking at a little more deeper into the various kind of risks that were factored in this first QIS. There will be a need to tweak them and bring in new risk parameters as well. And then the QIS 2 will be done sometime in the next 3 to 4 months. And so if I have to indicate a tentative timeline, then probably, I mean, it's not a hard and final one, because this will evolve. This is a very complex process. We need to take all the stakeholders also on board. and make sure that the transition is also a smooth one and as painless as possible. But in the long run, we do understand that the risk-based capital regime is a more efficient way of utilization and allocation of capital. So obviously, everybody will benefit in the long run. So the timeline would be for the risk-based capital, a parallel submission could start in the financial year 26 and the full-scale rollout in the financial year 2027. As far as the IFRS is concerned, again, work is in progress. So it is more of a principle-based approach you would understand and appreciate. So again, what recently we have commenced the gap assessment study. So the experiences were shared in the last 11th and 12th meeting that we had this November. And based on that, further work will start or is already started. So what we are expecting, again, a very tentative kind of this thing I'm making at this point of time, not hard and fast, that the parallel run should start somewhere in 25, 26. And, the full-scale implementation could happen in the year 27, financial year 27, 28. And as far as the risk-based supervision framework is concerned, 25-26 is our target, and somewhere in the financial 25-26, we would like to start rolling out the risk-based supervision framework.
There are certain issues like insurers today being forced to retain a lot more on their books in terms of, not having it passed on to the reinsurer, having just one sole reinsurance company in India, that is GICRE. Third one, a lot of capital flowing out of the borders of the country to cross-border reinsurance companies. Do these points concern the regulator at this point of time? And if yes, what is the regulator doing in terms of increasing the domestic reinsurance capacity in India?
Let me first give you a couple of numbers that see the premium that we had collected last year, that is financial year 24, 23, 24, that is as on March 31st of March 24, was 11.2 lakh crores. Yes, 11.2 lakh crores, out of which life was 8.30 lakh crores and non-life 2.90 lakh crores. So against 11.2 lakh crores, around 92,000 crores of rupees was can be assigned to the reinsurance also. 93,000 crores of rupees, that's not a small amount, a big amount. This amount is also growing, and the reinsurance market is also growing at around same 13-14% there, 13-14% here. In in October 2024, means the first 7 months, we have already earned a premium of about 6.5 lakh crores, registering a growth of about more than 12%. And we are still left with 5 months, and we hope that this momentum will continue. So what I'm trying to say that the reinsurance market will definitely also grow, and with newer risk coverages and a lot of other changes that have been we are witnessing in the market and the manner of discretionary spend. Surely and definitely this is going to grow. So more and more reinsurance capacity and support will be required. The regulator also has taken several steps to completely change the reinsurance landscape. One, from the ease of doing business, and two, also making it more attractive. Today, after the GIC, which is the only domestic reinsurer, all the FRBs and the offices which have been established in IFSCA, Gift City, Gandhinagar, which are called the IIOs, they are at the same footing because they will invest 100% of the premiums within the country, and therefore they are given the same order of preference, right? So I think now the CBRs, the cross-border reinsurers, will get attracted to come to the Indian market. They will obviously get a better deal if they go to the Gift City IIOs, because there are some additional benefits that they will get. However, they can also come to the domestic tariff area, given the new dispensation that has been provided, both in submission of lead terms and in placement of business, and they are being kept at par as far as the allocation or the placement is concerned in the order of preference. Even the regulatory returns and the application process for the FRNs, all of that has been rationalized and made easy to a large extent. So the entire ecosystem has been revamped, and that makes it more attractive for the CBRs to set up offices or shops in the GIFT City or in the DTA. So we feel that going forward and in the months and years to come, we will see more CBRs coming and establishing their shops in India.
Thank you so much, of course, to have this interaction with CNBC TV18 today on the Policybazaar Insurance Show. I wish you all the best, of course, for all the future endeavors and everything that you've lined up before yourself, before the regulator, IRDAI, and of course, the industry in the next few years. Thank you so much.
Thank you. I'd like to thank you and the viewers, the audience for listening to me. Thank you very much.
CNBC TV18, the Policybazaar Insurance Show.
Presented by Policybazaar.